After studying this module, you shall be able to know about NPAs or non-performing assets, learn the types and classifications of NPAs, identify the reasons for occurrence of NPAs, analyze the negative impact of NPAs on the performance of banks' operations, know the ways to control NPAs. Non-performing assets. Non-performing assets, or commonly referred to as NPAs, lenders consider these as those assets that are almost dead, that is, the chance of recovery is very low or no income is accruing to them. As on 31st March 2004, an NPA was defined as a credit facility for which the interest or installment of principal has remained pending due for a specific time period, at that time which was 4 quarters. The word is not something new to the bankers. When an asset is found to be unable to generate income for banks, then it is known as a non-performing asset. This is a very irregular but disguised loan asset. Due to strengthening of the payment, settlement and banking system, upgradation of technology in banking system, etc. It has been decided to come out with the new definition with effect from 31st March 2004. Meaning of NPAs. A non-performing asset is defined as a credit facility in respect of which the interest or installment of bond finance has remained past due for a specific period of time. If the borrower of loan fails to make interest or principal payment for 90 days, the loan is considered to be an NPA. Since the financial institutions depends on the interest payments as their income, these non-performing assets turn out to be a great problem for the financial institutions. With the effect from 31st March 2004, it has been decided to adopt 90 days overdue norm for identification of an NPA. This has been done with a view to move towards global standards, international practices, resulting in greater transparency. With effect from 31st March 2004, a loan or an advance is said to be an NPA when, in respect of term loan, the interest or installment of principal remain overdue for a period of more than 90 days. In respect of bills of exchange, if the bill remains overdue for a period of 90 days. In respect of an overdraft or cash credit, the account remains out of order for more than 90 days. In respect of advance granted for agricultural purposes, if interest and or installments of principal remains overdue for 2 harvest seasons but a period not exceeding 2 half years. In case of cash credit facility, non-submission of stock statement for 3 continuous quarters. The next is classification of NPAs. Based on the period for which an asset has remained non-performing and the probability of the realization of the dues, banks are required to classify non-performing assets further into the following 3 categories. First is substandard, second is doubtful NPA, which is again categorized into 3 parts, D1 that is up to 1 year, D2 that is up to 2 years and D3 that is up to 3 years. And the third is loss assets. Let us now do them in detail. Substandard. For this category, a bank made 10% provision of the funds from their profits to meet losses generated from NPA. The account holder comes in this category when they are unable to pay 3 installments continuously after 90 days and up to 1 year. Doubtful NPA. Under doubtful NPA, there are further 3 categories. D1 up to 1 year, that is banks make a provision of 20%. D2 is up to 2 years, that is banks make a provision of 30%. And D3, which is up to 3 years, in which banks make a provision of 100%. The third is loss assets. When an account holder enters in this loss assets category, the bank can write off his account from his books as 100% provision is mandated to be made for this. The next is types of NPAs. There are two types of NPAs on the basis of their methods of calculation. First is gross NPAs and the second is net NPAs. Gross NPAs. Gross NPA is an indicator of the quality of loans lent by the bank. The sum total of all loan assets, which consist of all the non-standard assets, for example substandard, doubtful and loss assets, that are classified as NPAs by the bank as on the balance sheet date, it can be calculated with the help of the following formula. Gross NPA ratio is equals to gross NPAs divided by gross advances. Net NPAs. Since in India, bank balance sheets contains a large amount of NPAs and the process of recovering and writing off loans is extremely time consuming, the banks are required to make certain levels of provisions regarding the occurrence of NPAs. Net NPA shows the actual burden of banks. It does so by deducting these provisions from gross NPA. It can be calculated with the help of the following formula. Net NPAs ratio is equals to gross NPAs minus provision divided by gross advances minus provisions. The next is reasons for the occurrence of NPAs. In the financial world, the failure to meet financial obligations, say non-payment of loan installment, etc., is known as default. These default or bad loans leads to NPAs. So these defaults which causes NPAs may occur due to the following reasons. Usual banking operations or bad lending experiences, a banking crisis, change in the government policies, failure of the business or the concerned purpose for which the loan was taken by the consumer, overhang component. Now this component usually is a mix of environmental reasons, business cycles, etc. Incremental component. Now this component is a mix of issues related to internal management of the bank like credit policies, terms of credit, etc. Lack of proper pre-inquiry by the bank before lending a loan to the customer. Willful defaulter. Loans sanctioned for agricultural purposes and the failure of monsoon and thus the yield. So these are some reasons for the occurrence of NPAs. The next is NPAs and its impact on the banks. NPAs have a great impact on operational banks. They not only affect the balance sheets, but along with it, they bring a whole lot of other problems with them in the financial institutions. Major areas of their impact are following. First is profitability. NPA hampers the profitability of a company, bank, NBFCs, financial institutions, etc. NPAs are nothing but defaults or bad assets which may happen as a result of the reasons discussed earlier. So, the money gets blocked and hence the profits of the company in an NPA. But it is not only this impact, but NPA also leads to opportunity cost, as that much of the profit could be invested in other opportunity or return generating projects or assets. So, NPA not only impact the current profits but also future stream of profit, which may lead to the loss of some long-term profitable opportunity. Another impact of the reduction in profitability due to an NPA is low return on investment, which affects the current earnings of the bank. The next is liquidity. Liquidity for a bank is a very important issue. Even RBI has given the guidelines for banks to keep a certain amount of deposits always in liquid securities. Due to NPAs, the money of a financial institution gets blocked, the cash inflows decreases due to lesser profits, which leads to less liquidity or lack of enough cash at hands. This leads to borrowing of money by the company for the shortest period of time, which increases the current liabilities as well as the burden of interest on borrowings for the company and thus leads to an additional cost to the bank. It also leads to difficulty in performing operating day-to-day activities for a bank. The next is involvement of management. It sums up to be a great burden on management of a bank. The management is already shouldered with a lot of work. It leads to cost of time and efforts of management. Efforts and time of the management are another indirect cost which banks have to factor due to an NPA. if these same wasted efforts of management in handling NPAs were diverted to some other beneficial or return generating activities, it would have generated profits and yielded better balance sheets for the banks. Nowadays, the banks have started hiring special employees and making specialized departments to deal and handle NPAs, but they act as an additional cost to the bank. Next is credit loss. Non-performing assets also hinder the creditworthiness of a bank. The value of the bank in terms of the market for credit is extremely negatively impacted for those which have large NPAs on their books. It drives away the investors and the people who are putting their hard-earned money in the banks and also result in the loss of brand value, image and credit strength. The next topic which we are going to study now is the measures to control NPAs. In present scenario, NPAs are the core of the financial problems of the banks. To improve recovery performance, concrete efforts have to be made. Measures required to be undertaken are mainly twofold. Firstly, banks should make efforts to avoid fresh addition of NPAs by their effective pre-sanctioned appraisal. Secondly, to recover the amount from the accounts which have already turned bad. These measures are namely of two types. First, preventive measures and second, curative measures. Preventive measures. These measures are used to prevent the new additions of NPAs for a bank. Most of the bankers feel that there are a number of ways by which they could prevent the additions of funds into the non-performing category. They can be: banks should first of all reformulate these credit appraisal techniques. Next, proper evaluation of the loan applications must be done before taking them further down the processes. Next, cells such as industrial cell should be established at the bank level, which would have complete information about the industry and its prospect in future. Next, proper credit monitoring should be done. The information regarding the annual accounts, stock reports, etc. of the units must be flowed smoothly to the bankers so that they could now know the need-based credit requirement of the borrowers. Next, for those projects or businesses the loan has been given by the bank must inspect their progress. Separate monitoring departments should be established in large branches for the review of accounts, comparative risk analysis, and to see that terms and conditions of the sanction are compiled with. Next, banks should be equipped with the latest credit risk management techniques to protect the bank funds and minimize insolvency risks. Next, banks should develop the credit derivative markets. The senior official and officers from the public sector banks should be encouraged and regularly sent to specialized training institutes so that they can modernize and equip themselves with current practices and latest frauds detecting techniques, including online courses. The next measure is curative measure. Banks have to take steps to recover the amount from those assets which have already slipped into the NPS category. These measures are to be taken side by side by the preventive measure. One of the reasons identified were slow recovery of legal cases, willful default induced by officially announced loan waiver schemes, etc. The Indian legal structure is thinking about the stressed borrowers, but it acts against the interest of the banks. Despite most of their loans being backed by collateral, the loan recoveries are still insignificant. The Narasimha Committee on Financial System in 1991 has recommended the establishment of debt recovery tribunals known as DRT for the speedy recovery of the assets from the NPAs category. 22 debt recovery tribunals were established by passing a bill on recovery of debt. But for the past some years, DRTs are not found satisfactory or up to the mark. Suggestions are made regarding the amendment of DRT Acts so that more presiding officers can be recruited to carry on the speedy recovery of the assets from the NPAs category. Government should not go for mass waiver of interest and installments, as it questions the credibility of the system in the eyes of the borrower. There was a massive waiver of rural debt amounting to Rs 15,000 crore in 1991 and Rs 65,000 crore in 2008. These types of activities put a premium on willful default and dishonesty. It lowers the repayment ethics. The government should take steps and become stringent in their positions to protect the banks from NPAs. Let us now learn what we have studied in this module. The overall performance of banks is reflected by the NPAs. The higher the NPAs, the higher will be the probability of large number of defaults, which affects the profitability and liquidity of the banks. Public sector banks face more problems in terms of NPAs. Also, government has taken various steps to reduce NPAs. However, NPAs can never be zero. The banks should be vigilant enough and check the credit worthiness of the customers while giving loans. The asset of the banks which don't perform, that is, don't bring any return, are called as non-performing assets or bad loans. Banks' assets are the loans and advances given to the customers. If customers don't pay either interest or part of principal or both, the loan turns onto the bad loan. According to RBI, terms loans on which interest or installment of principal remains overdue for a period of more than 90 days from the end of a particular quarter is called a non-performing asset. However, in terms of agriculture or farm loans, the NPA is defined as under: for short duration crop agriculture loans such as paddy, jowar, bajra, etc. If the loan is not paid for 2 crop seasons, it would be termed as an NPA. For long duration crops, the above would be 1 crop season from the due date. Contains provisioning coverage ratio for every loan given out, the banks to keep aside some extra funds to cover up the losses if something goes wrong with those loans. This is called provisioning. Provisioning coverage ratio, that is PCR, refers to the funds to be set aside by the banks as a fraction to the loans. Standard asset: if the borrower regularly pays his dues regularly and on time, bank will call such loan as its standard asset. As per the norms, banks have to make a general provision of 0.40% for all loans and advances except that given towards agriculture and small and medium enterprises sector. However, if things go wrong and loans turn into bad loans, the PCR would increase depending on the classification of the NPAs as discussed in the next section. Classification of the NPAs: banks are required to classify non-performing assets further into 3 main categories, that is, into substandard, doubtful and loss NPAs based on the period for which the asset has remained non-performing. This is as per transition of a loan from standard loan to loss asset as follows. If the borrower does not pay dues for 90 days after the end of a quarter, the loan becomes an NPA and it is termed as special mention account. If this loan remains SMA for a period less than or equals to 12 months, it is termed as substandard asset. In this case, bank has to make provisioning as follows: 15% of outstanding amount in case of secured loans, 25% of outstanding amount in case of unsecured loans. If substandard asset remains so for a period of 12 more months, it would be termed as doubtful assets. This remains so till the end of 3rd year. In this case, the bank need to make provisioning as follows: up to 1 year, 25% of outstanding amount in case of secured loans, 100% of outstanding amount in case of unsecured loans, 1 to 3 years, 40% of outstanding amount in case of secured loans and 100% of outstanding amount in case of unsecured loans more than 3 years, 100% of outstanding amount in case of secured loans and 100% of outstanding amount in case of unsecured loans if the loan is not repaid even after it remains substandard asset for more than 3 years. It may be identified as unrecoverable by internal or external audit and it would be called loss asset. An NPA can declare loss only if it has been identified to be so by internal or external auditors. For example, we suppose that a party was disbursed a loan on January 1, 2010. Its due date is June 1, 2010. But the party does not make a payment. So it will be an standard asset from January 1, 2010 till June 1, 2010. Due date. It will be a special mention. Account from June 2, 2010 till August 29, 2010, that is 90 days, it will be substandard. From August 30, 2010 till August 29, 2011, it will be doubtful, and from August 30, 2011 till August 29, 2012, it may remain doubtful asset for a period of 3 years, beginning from 12 months of being an NPA. But once the auditors identified it as loss, it will be assigned a loss asset. However, the period may be anything above 3 years. Implications of the NPAs on banks. The most important implication of the NPA is that a bank can neither credit the income nor debit to loss unless either recovered or identified as loss. If a borrower has multiple accounts, all accounts would be considered NPA if one account becomes NPA. Gross NPA and net NPAs. The NPA may be gross NPA and net NPA. In simple words, gross NPA is the amount which is outstanding in the books regardless of any interest recorded and debited. However, net NPAs is the gross NPA less interest debited to borrower account and not recovered or recognized as income. RBI has prescribed a formula for deciding the gross NPA and net NPA. NPA and SAR-FAESI Act, that is SAR-FAESI Act, the securitization and reconstruction of financial asset and enforcement of security interest, that is SAR-FAESI Act, has provided provisions for the banks to take legal recourse to recover their dues. When a borrower makes any default in repayment and his account is classified as NPA, the secured creditor has to issue notice to the borrower giving him 60 days to pay his dues. If the dues are not paid, the bank can take possession of the assets and can also give it on lease or sell it as per provisions of the SAR-FAESI Act. Reselling of NPAs. If a bad loan remains NPA for at least 2 years, the bank can also resell the same to the asset reconstruction companies such as Asset Reconstruction Company of India, known as AIRSEL. These sales are only on cash basis and the purchasing bank or company would have to keep the accounts for at least 15 months before it sells to other bank. They purchase such loans on low amounts and try to recover as much as possible from the defaulters. The relevance is difference between the purchased amount and the recovered amount.